welcome you with us here on Market Guru. Joining us today, Shiv Puri of TVF Capital Advisors. Shiv, good to have you with us. We're closing the week with we're closing the week, Shiv, with a rebound across equity markets globally. Are you taking heart from that, or are you still watching out for further volatility?
Well, I think with what's happening globally, one should expect volatility to be par for the course this year.
Right.
You're seeing the after effects of a pretty huge bubble bursting, which is the commodity bubble. And we've seen a few bubbles over the last 10 years bursting. And, when that happens, usually the effects, go on for a little while. So it's hard to say that volatility is behind us. From an India standpoint, I think there's some pros and cons. The fact that this is a pretty significant bubble that's caused pain for companies across the world, for countries across the world, will have an impact on financial flows into India. And also there are some companies in India that made a series of big acquisitions globally and took on some leverage, which will feel the pain of this. But net, I think this is a big positive for India, where the commodity prices are today. And if India can get the infrastructure cycle going at this time, whether it's in the next 6 months or the next year, what better time to spend on infrastructure when the raw material prices are down by 50%? So I think net it looks positive, but I certainly feel there's more volatility ahead.
In that sense, then, when we talk about a more volatile environment, what do you believe are going to be some of those factors that, India probably needs to get together? Because, in the last couple of days, you can talk about the way the relative valuations really play out and how India really stacks up in the entire EM basket. But somewhere it's also about the macro growth story. It's also about the reform story. That's really got a lot of FPIs, a lot of foreign investors excited about India. So in that sense, what will you be really watching out if the markets on a global front are expected to get volatile? Domestic cues, again, might start getting important.
Yeah, I think the most important thing in India is to watch the capex cycle pick up, is to watch the infrastructure cycle pick up. And so far, there's been lack of evidence of that happening. You've seen some, stalled projects where a little bit of work has started. You've seen some policy announcements by the government. But the fact remains that the biggest lenders to the infrastructure projects, which are the state-run banks, will still have a lot of issues ahead of them, despite the latest infusion of capital. The fact remains that the balance sheets of the developers are still quite strained. So it's going to take a little bit of time, but for me, the single most important thing is to get the capex cycle going, and that will have a big benefit to the growth rate, because right now it's contributing nothing to the growth rate.
Right. Shiv, some of the concerns around the global growth picture also are remaining. We keep getting estimates or revised estimates on China, for example. We had macro data out of the US last night. Just how are you tracking some of those cues? We're watching out for commentary from Jackson Hole as well. Even though our own picture, of course, is still looking better than some of the other economies, any kind of headwinds you see because of real economy or growth concerns in some of the other key markets?
It's very hard to figure out any of that, and so as a result, we spend very little time on it. The GDP number in China, I don't know if anybody knows what the real number is. We certainly don't. So we pay little attention to any of that. I think the focus should remain for anybody who's looking at India, on India, because it is largely a domestically driven economy. Capital flows, of course matter, but India's trade with the rest of the world is very small. Domestic demand itself is big, and we need to get the catalyst for it to pick up. But India is one of those few countries which is a big economy, which is domestically driven, and as a result, those factors will play a much bigger role over any medium period than the global growth environment. And I think, at this point, these big shakeups, if they happen globally, really present opportunities to look at quality companies, to look at businesses that might get sold off because of top-down macro concerns, and really focus on buying these quality businesses, when they become reasonable in terms of valuations.
In that sense, how crucial do you believe would the rate trajectory be as far as the RBI strategy is concerned there? Because that's been the other talking point. I mean, on one hand, we've been seeing what's happening on the global front. We've seen what PBOC also has been doing in the last couple of days. What are your expectations from the RBI?
Well, I think the real effective interest rate in India is incredibly high. It's maybe higher than most other markets anywhere in the world. We've seen, the WPI be in negative territory. The CPI, is now at 4% or thereabouts. And so, I think the trajectory has to be down. It is understandable that the governor wants to take his time to make sure that the glide path of inflation is, under 6% by next year. But I really feel that monetary policy in India is quite tight, especially given the deflationary backdrop from the bursting of the commodity bubble.
Right. Fair enough. So, Shiv, let's talk about those domestic cues in a bit more detail. I mean, you mentioned, of course, the entire CAPEX theme, but let's take a look at some of the factors that we've been discussing. Crude shot up yesterday 10%, so we can't rule out perhaps any kind of gain in those commodity prices and what that could mean for us. And while inflation has been looking steady, we're still not any closer to that rate cut. So when do you really expect things to pick up? We haven't had any action on key reforms like GST, for example. When do you really see things picking up, or what will you be watching out for really in the near term?
Yeah, I mean, in terms of the reform side of thing, obviously, I think GST is the big one, and hopefully that is something that passes in the next session of Parliament. Of course, the previous one, everybody found to be disappointing. That is one big positive that can happen from the reform side. The land acquisition bill is also important. But a lot of the state governments hopefully take the initiative at the state level to move that forward. So that's on the reform side. Regarding interest rates, I think it's possible that you see a rate cut any time, even if it's out of the meeting, like it's happened 2 or 3 times by the governor over the last one year. It's certainly possible. I think the RBI has announced what they're monitoring, and we hope that some of that plays out over the second half of the year. But my sense is we're probably closer to at least one rate cut than before.
All right, so let's see if we manage to pick that up or not. But in terms of portfolio strategy, Shiv, let's get a little specific in terms of sectors that you're focusing on. Well, as you've been saying, these kind of erosions, these kind of cracks in a market like this are fabulous opportunities for probably long-term investors to actually look at the market. Have you taken some bit of churn in terms of the portfolio? Have you taken a relook at some of the stocks that probably looked expensive? Just to get a sense from you as to if you've made any changes to your portfolio recently.
Well, we don't recommend on a few days of movement to do anything too drastic. Okay. So there's not anything significant that happened. But, there's some interesting trends. I mean, if in an environment like this, some high-quality companies, let's say in the pharma sector, would sell off, which they have, those are interesting opportunities. They benefit from the decline in the currency, which is down 4% this month. They are seeing generally a good environment. There is this overhang of FDA and approvals, which we think is temporary. The good quality companies will overcome it, and so these are opportunities for doing some work in areas like that.
Right. What would you be doing with some of the rate sensitives at this point, specifically financials as well, Shiv, for various reasons? As you mentioned, lots of highly leveraged companies, so still a lot of exposure and risk. We had the RBI governor once again reiterating that that's a priority for him. And not necessarily, of course, that we'll see a direct impact anytime soon of any rate cut on some of the banks. But what really would you advise, and how would you stack up the private versus public at this point?
I've always felt that in financial services, the most important thing that matters is the quality of the management. And if anyone, I think, in India would applaud that in terms of who they think are the best 4 or 5 management teams going back 5, 10, 15, 20 years, they would see that they consistently deliver value and everything else just happens to be cyclical. Great management teams understand this, are very important in the financial services business. They're the ones who are able to build a quality deposit base, manage risk, grow in a prudent manner. And that's all that's really required in financial services in India, because the tailwinds are incredibly favorable given the underpenetration of banking in India as a whole. So I think that rather than look at opportunities where one wants to play anything cyclical, our strategy has always been look at when quality goes on sale in the market, and that's the time to be looking seriously at picking up or investing in those kind of companies. I think the other important dynamic in financial services, specifically since you asked, are two. One is that the state-run banks will have issues on balance sheet for several years. Despite the government infusion, the state of the balance sheet of their balance sheet will not allow them to grow for the next few years. And as a result, the private sector banks, the well-run private sector banks, will consistently gain market share at a faster pace than they have done before. And the second thing is that digital banking is picking up quite rapidly. I mean, we've seen the data of how the number of people, especially the young, are accessing their account online through mobile phones. And the private sector banks are using that to their advantage. They're using technology to lower cost. Some of the state-run banks are still far behind in that initiative, and I think that's a structural change. So, for these reasons, I think that one should remain focused on some of the well-run private sector banks, as they get washed out, perhaps, in any sort of volatility that comes.
Sure. Since you're talking about trying to spot opportunities in this market, or trying to look at ones that have actually eroded, it's been a pretty big sale that's been going on in the mid-cap space as well. These stocks have eroded anywhere between 20 to 40% in this entire meltdown that we've seen, and they've taken a huge knock as well. What do you make of this entire erosion in the mid-cap space? Would you stay away from it, or you believe that there are still selective stocks that one can probably look at even in this market?
It's hard to generalize across the entire mid-cap space. We tend to focus on specific opportunities. But I think generally, if you ask, the higher quality companies in the mid-cap space have probably corrected the most, because the poorly run businesses or the companies that had, compromising balance sheets or were in certain industries, they haven't really, they had corrected a while back. And so this is largely driven by, capital outflows or, valuation concerns. And, I think it's healthy. It's great that there is a correction in some of these names. And in a healthy market, it should happen from time to time.
All right. So that's as far as the mid-cap space is concerned. But Shiv, before we wind down our conversation, want to get a quick comment from you. Any thoughts if Jackson Hole is going to be as critical as we've seen in the past, or any expectations as to what we could possibly see from there?
It seems that from all the commentary that we've been reading, that, the September, rate hike that was, being talked about 3 weeks ago, the probability of that happening has now gone down. Okay. Although I will say that if you look at the GDP numbers coming out of the U.S. last night, which are pretty strong, that puts them in a bit of a spot. So I don't think anything too material can come out of this meeting, but one has to sort of wait for a couple of weeks for the Fed to figure out what they're going to do next.
All right, Shiv. Thanks so much for joining us, and have a good weekend.
Thank you. You too.
That's where we'll leave it this morning on Market Gurus. Please stay tuned after the break. Pre-open as well as the review open.